Hello, and welcome to this episode of To the Point. I'm Neil Stanley. Today we're going to talk about the confluence of solvency, liquidity, and technology in terms of the March 2023 banking crisis. In our economy recently, we've seen some good things. We've seen GDP growing. We've seen inflation moderating. We've seen unemployment staying low. In general, we would think that these are very positive things. In fact, the GDP now from Atlanta recently reported that we might be on a pace for a 3% GDP growth in the first quarter of 2023. So this should be good news for all of us. Yet there's some concerns that have shown up this past week very, very gravely. This is a consequence of some things that have happened not just this week, but over decades. When you look at the nature of deposits in the United States, you see something very dramatic. You see the decline in maturing deposits, as we were once over 50%. And even just before the Great Recession, we were over 35% with deposits that had a contractual maturity, that people were obligated to keep them with the bank for a period of time. But since then, those deposits have fallen to less than 10% of the base, with about 30% of the deposit base recently being in non-interest-bearing deposits. And then the non-maturing interest-bearing are now at 63% of the industry, which means 90% of the funds could leave at any moment. Now, most bankers haven't been too concerned about this because the fact that they haven't had to lock up the money means that they've typically had to pay a lower rate because they haven't had to pay a liquidity premium to give themselves access to longer term because the depositors are happier to keep the funds at lower yields when they have access to their money at any time. But now we're seeing a shift because the reality is if 90% of the deposits could leave at any time, that's a risk. That's a threat. And even though it may have contributed to the interest margin being healthier, how stable is it? How durable is that? So let's look at the Silicon Valley banking crisis. What we see is that data that was reported by the end of January for the bank shows some very interesting things. When we look at any one thing, we might feel okay, but let's look at the specific details. First of all, they had a very large securities portfolio. 60% of their assets were in the investment portfolio. They had a low portfolio yield. Their bank reported the taxable equivalent yield on securities was 1.75. That's low. That's very low. And you think, well, if it's a year long, maybe that's okay. But you look at the data, and the data they reported said that 25% of their loans and securities were over 15 years to maturity, and the median was 13. They were more than twice as long. Any one of these things can be of concern, but to have all three together tells you there was some mismanagement in terms of overextending low rates in an environment that dictated that the Fed had to raise rates. The Fed had no choice to deal with inflation. And yet this management team was not responsive to that. They doubled down and tripled down on their investment portfolio bets. Their unrealized security portfolios as a result were not just in the available for sale, which is shown in accumulated other comprehensive income, but it was also in their held to maturity portfolio. They tried to shield their capital by putting bonds in the held to maturity portfolio. They had 91 billion of their securities as a cost basis was in held to maturity. But the fair market value of those securities was only 76 billion at the end of December. That was before rates had risen more in 2023. That means that they were reporting a $15 billion unrealized loss in the held to maturity portfolio. 16.6% of the value of the securities had depleted because of interest rates. Then in the available for sale, which they were reporting, $2.5 billion worth of depreciated value, of diminished value. So in total, the unrealized loss, $17.6 billion. And then when you compare that to the reported capital of the bank, you see the solvency issue. 17.6 billion of unrealized loss, 15.5 billion of reported capital. We've got a major problem. The uninsured deposits then, 151 billion. This means that large account holders accounted for 151 billion. Well, how much is that of the total? The total was only 161 billion. This tells you that this bank was full of super large, supersized deposits. And when those supersized deposits became anxious about their potential to become an unsecured creditor in the potential of an insolvent bank, they wanted out. And they wanted out fast. And so 94% of the deposits were uninsured. And that means that they hit the trigger. And on March 9th, when everyone who had felt comfortable that they could manage their money because at the press of a button they could move lots of money out, all got anxious. Many of them got anxious at the same time. $42 billion was moved, was the outflow in March 9th. Folks, this was a crisis that occurred not because of credit quality. It came about because of poor interest rate risk management, insolvency, illiquidity, and an inability to understand what open banking technology was going to do in the case of a potential run on the bank. Now, they're not alone. I don't publish this on LinkedIn, but I am sharing it with you, my audience here on YouTube. This is not something that's seen broadly, but this is public data, so I'm not sharing anything confidential. This is published data as of December 2022, and you will see that Silicon Valley had 94% of their deposits of their domestic deposits were uninsured. But they were followed closely by Signature Bank, which also was closed. They're not alone, though. There are other banks on here that are vulnerable to these kinds of situations. When you look at the statistics then, you can find that the weighted average for banks, only banks over $1 billion are required to report uninsured deposits. And of those reporting, 48% of the deposits that were reported banks had 48% of their deposits, of their domestic deposits that were uninsured. The 25th percentile, in other words, 25% of banks that reported had a number less than 24%. The median was 34%. But once you get into 95th percentile, in other words, a very small portion of banks have very large portions of their deposits that are uninsured. So what do we recommend? We recommend for all the banks that are finding this environment post the crisis, many of you are finding that the first impact on your bank is that depositors are finding a safe home with you. They are moving money to you, and that's a good thing. But be aware that the subsequent waves will come as the spotlight has been turned on, and all depositors, the ones that were sleepy, have no reason to sleep anymore. They're going to be alert to value, which is not only safety, soundness of your institution, but also value of that deposit. Once they start moving, they're no longer going to be just content just getting no interest. They're going to want to know how that they can make their money work for them. So you're going to have your game in order, which means you need to communicate the difference between you and the crisis banks to your board, your management team, and the front line. They need to understand the strength of your capital after unrealized losses and held to maturity and available for sale. They need to understand the relative size, yield, and duration of your securities portfolio compared to these crisis banks. They need to understand what the uninsured deposits to domestic deposit ratio is. Because if you have a very low uninsured deposit base, you're not going to be vulnerable. You're going to be able to cover all the liquidity issues you have in your bank. So be sure to role play conversations with your team on an ongoing basis as situations develop. Have conversations. Make sure that you are over communicating your strength and your posture and your and the confidence because you are solvent, you have liquidity, you have resources, you have that contingency funding system in place with FHLB and other resources. The other thing you need to do is throw away your decay stress test that you had previously. Because if you are using something that says your demand deposits have a 6, 7, 8, 9, 10-year life, it's not valid in this environment. You need to understand what that true deposit decay stress test is going to look like in this environment and rerun those economic value of equity numbers so that you are relevant to what could happen in this situation. And then communicate with clients and your community the things you know about your strength, your solvency, your liquidity, your ability to cover the deposits that might be interested in withdrawal, and the fact that you are not in this vulnerable position that some have found themselves in. So proactively reach out to your largest and best depositors. We recommend putting your treasury management team in action, having communication with all of those depositors that have over the insurance limit. And then be sure that you are prepared to show them how you can arrange to have their accounts be covered by FDIC insurance. You can use the electronic deposit insurance estimator that the FDIC provides. You can also use things like CEDARS and other tools to make sure that there's coverage for uninsured deposits. We know for sure that that number is going to decline greatly from the 34% median that it's been at. You can either participate in that actively to help get depositors comfortable and secure and confident in what's going on with your bank and your sector of the economy. So I want to thank you for taking time. I hope you found this to be valuable. I value the opportunity to meet with you. Don't hesitate to set up an appointment with me using my Calendly.com link there. It is a pleasure to present these episodes of To The Point to you. I wish you a very successful endeavor as you work through these issues with your team. I look forward to presenting the next episode of To The Point. Until then, make it a great day.